What are the best assets to own in a long-term investment portfolio? That's what we're talking about in this video. Hi, I'm Clark Atterbury, and for the last 30 years I've been helping individuals, families, and small businesses to manage their investments and work toward their financial goals. First, let me clarify what I mean when I say a long-term investment portfolio. I'm not talking about 6 months or 1 year or 3 years. I'm talking about a portfolio spanning years or decades. To help you understand what are the best investments for a long-term investment portfolio, let's talk first about what choices are on the menu. Imagine you walk into a restaurant where you've never eaten before, and out of the blue the waiter comes up and says, "What would you like to eat?" You might say, "Well, before I can choose, I want to know what's on the menu, so can you show me the menu?" So what I want to show you is what's on the investment menu. Most people, when they think of the investment menu, probably think of the Wall Street Journal or Barron's, or if you're doing your research online, maybe it's MarketWatch or Yahoo Finance. If you dive into the stock tables, you'll see thousands of symbols and numbers and fractions. For most people, it's like trying to read a foreign language. So let me help you out by putting it in plain English. While there are thousands of choices, it helps get your mind around it if you understand that all those different things fall pretty neatly for the most part into just one of three main categories. There are stocks, there are bonds, and there's cash. Now, of course, you can put your money into real estate or invest in your own business, but in this video, we're talking about what you can do in your brokerage account. Stocks are ownership of publicly traded corporations. A share of stock is a unit of ownership in that corporation. Here, for example, are some of the corporations we all know and use. You get it. Bonds, on the other hand, are not ownership. They're more loanership. You're lending your money out to some corporation or government entity. Cash, as we all know, is checking accounts, savings accounts, certificates of deposit, or money market instruments. Cash is a great place to keep your short-term money. What do you think is riskier, stocks or cash? Most people would say that stocks are the riskiest because they have the potential for principal loss. Let me help you to understand a little different perspective. In the short term, stocks are way up there. Stocks have been known to lose 20% in a day. So you could say the short-term stocks are quite risky. But the longer you're investing, we're talking about a long-term investment portfolio here after all, the longer you're invested in a very diversified stock portfolio, the less the risk of principal loss. Cash, on the other hand, in the short term is very low risk. A dollar is still going to be a dollar tomorrow. You don't have to worry about it becoming worth 80 cents. But long term, cash is guaranteed to lose us purchasing power. And the longer we leave our money in cash, the less it's worth, and that goes on indefinitely. If 20 years ago you had taken $100,000 and put it onto your mattress and you pulled it out today, let me ask you a question. Have you lost money? You might say, no, I've still got $100,000 of units of currency. But you know, and I know, that $100,000 doesn't buy anywhere near as much today as it bought 20 years ago. So you lost money in purchasing power, which is what it's all about. Inflation is real. I'm not making this stuff up. You know it. I know it. The longer the time passes, the more stuff costs. In other words, the less your dollar is worth. This chart shows that $100 in 1900 is worth $3.06 at the end of 2020. You can't tell me that's safe. Here's another way of looking at it. If you'd invested $1,000 back in 1925 and you put it in the S&P 500, it would have grown to over $10 million today. Now, if you had just left it in the bank, you'd have to have $16,000 today to buy what you could have bought for $1,000 back then. I know that's kind of hard to see, so I'm going to zoom in. It took $16,000 to buy what you could have bought with $1,000 back then, and the $1,000 invested in the S&P 500 became worth over $10 million. Okay, back to the menu. There are stocks, there are bonds, and there's cash. As we've just seen in these charts, stocks have had a much higher annual rate of return over time, which has averaged something like 10%, where bonds have averaged about 6% per year, and cash, long-term average, is about 3%. I'm not saying any of these are this year's rate of return. These are the long-term historic averages. That's not all, though, because if you earn 10%, maybe you're going to pay 3% in taxes, and you're going to lose 3% to inflation. So your real net rate of return after taxes and inflation is about 4% per year. With bonds, it's 1% per year. And with cash, you're losing 1% per year. Tell me that's a safe investment. It's a great way to grow safely poorer. Now, we both lived long enough to know there's no something for nothing. There's no free lunch. So what's the catch? If stocks pay considerably more than bonds, which pay more than cash, what's the catch? Cash grows steadily. You may be losing money net of inflation and taxes, but there's never a big dip. Whereas stocks, they may pay you these rates of return over time, but the price you pay for that is to endure these downturns that we see periodically. And if you don't endure it, if you buy here and you sell here, or here, or here, you lose money. So the price we have to pay if we want to realize the higher rates of return that stocks have given investors over time is we have to be prepared to endure, to expect these short-term downturns and to not sell it when it's down. Now, bonds have both an in-between rate of return and also an in-between amount of fluctuation. They're not as stable as cash, typically not as volatile as stocks. Now, since cash is losing 1% per year net of inflation and taxes, it's a terrible investment choice for your long-term investments. Yes, you need cash, but not in your long-term portfolio. That's a separate question. So let's take cash off the table and just talk about stocks and bonds. If you were to say to me, Clark, I get it, stocks have a much higher rate of return, I'm prepared to endure the significant short-term price fluctuation in exchange for those higher returns, what stock should I put my money into? If I were to tell you to put all your money into the stock of a single corporation, hopefully you would get up from the table and leave, because you should never put all your money into the stock of a single corporation, because end runs happen. If you put your money in the stock of one corporation, that corporation could become worth nothing and never come back. Not only do you not want to put your money in the stock of one corporation, you don't even want to put your money into one stock market. We've all heard of the S&P 500 or the Dow, and people usually, when they say how the stock market today, they mean how was the Dow or the S&P 500. But the fact is, there are many different stock markets. And it's smart to diversify among the different markets. This helps us to reduce correlation. There's a big fancy word with a simple meaning. It just means, do the investments behave exactly the same way at the same point in time, or do they not? If they have low correlation or negative correlation, they tend to not march to the same drummer. One way to invest among different stock markets is to invest in stocks of different capitalizations. There's another fancy word with a simple meaning. Capitalization just means what's the value of a corporation as measured by the number of shares in circulation times the price per share. So if Clark Inc. were a company and I had 100 shares of stock in circulation and they were trading at $5 per share, what would my market capitalization be? Right, $500. CAP stands for capitalization. You may have seen this on your 401k statement or other mutual fund choices. Large cap, mid cap, small cap. Another way of saying that, it really ought to be big, bigger, and biggest, because even small cap stocks are $100 million corporations. We're not talking about some family-owned neighborhood market. So you can diversify amongst large cap, mid cap, small cap. You can also diversify geographically. You don't have to invest only in the United States. If we add international to the equation, it again should reduce the correlation of our portfolio. By the way, when I was a kid, 75% of the world's stock market capitalization was here in the US. The rest of the world accounted for only 25%. That's flipped. Now, 25% of the world's stock market capitalization is American companies. 75% of it is in non-US countries. So you probably don't want to ignore international companies. Here are a few international companies that you're probably familiar with. Another way to diversify among different stock markets is by investing amongst different investing styles. Imagine that you and I are both mutual fund managers for large cap US stocks. You are a growth manager, I'm a value manager. What's the difference? You're comfortable paying relatively higher price to earnings ratios for the stocks in your portfolio. You're looking to earn capital gains, and you don't care if the stocks in your portfolio pay dividends or not. I, as a value manager, on the other hand, while I'm starting with that same universe of large US stocks, have a different funnel. I'm looking for companies that are lower price to earnings ratio, out of favor with the markets for one reason or another, but I think that's going to change. And I'm not looking so much for capital gains as I am for dividends. We can get deeper into this, but for the purpose of this conversation, let's just say that they're different and they don't march to the same drummer again. Growth and value are like two lanes of traffic on the freeway. We've all been there, where you're sitting in one lane and it's not moving. The lane next to you is moving, so you get over from one lane to the other. What happens? That lane stops, the other lane you just got out of starts going. That's growth and value. They tend to not behave the same way at the same time, although over a long period of time, they both do well. So imagine you have large cap growth, large cap value, mid cap growth, mid cap value, small cap growth, small cap value, and international. And if we're going to have some money in a bond portfolio, we'd better diversify that too. You can diversify by duration. That means how long the term of the bond is. Is it 1 year, 3 year, 5 year, 10 year, 30-year bond? There are short-term bonds, there are intermediate term, and there are long-term bonds. With bonds, just like with stocks, you can also diversify geographically US and non-US issuers. And you can diversify your bond portfolio by credit quality. Now, you and I, we have FICO scores. If your FICO score is higher than mine, then you're going to pay a lower interest rate to borrow money than I would have to, say for a car loan, for example. Well, just like we have FICO scores, corporations and governments have credit ratings. They're rated by companies like Moody's and Standard & Poor's, and they have different credit ratings. There's a continuum from the very best to the very worst. Little zone up here at the top they call investment grade. They have the highest credit rating, if you will. And then the rest of it, below investment grade, there's a number of different degrees of high yield bonds or junk bonds that have relatively lower credit ratings and pay higher rates of interest rate accordingly. Now that we've talked about diversifying among different asset classes, I want you to think about diversifying in turn within each asset class. And here's where a concept of mutual funds or index funds comes into play. A mutual fund or an index fund is a basket full of a given type of investment. So imagine in the category of large cap growth, you have a basket of maybe 500 different large cap growth stocks. And then in the large cap value, you have another basket index fund, mutual fund. And same thing for mid cap growth, mid cap value, so forth and so on, short term, intermediate term, long term, high yield bonds. So diversifying among different markets and then in turn within each of these markets. Here's another way to think of it. Imagine you have a pie with all these different slices, and each one of these slices is one of these different markets that we're diversifying amongst. And if you look under the hood, we don't have 1 or 3 or 5 things in each category. You've got a basket of 500 or 1,000 things in each category. So your money's literally diversified among thousands of things globally. Now I often get the question, Clark, why would you have us invest amongst all these different things? If you're such a smart financial advisor, why don't you tell us which one of these things is going to be the best performer in the next 12 months and let's put all of our money into it? But here's the thing, a financial advisor does not have a crystal ball. Well, actually I do. I have a crystal ball. It has a sign on it that says out of order. Trying to divine which of these different markets is going to outperform the others is just as likely to underperform a diversified portfolio as it is to overperform. Take a look at this periodic table of investment returns. This is a year-by-year relative performance of the different asset classes. And you'll see the different colors. They're like looking at these different asset classes or the different slices of the pie. And what you'll see is the different asset classes take turns outperforming in each other. Just because something was hot one year doesn't mean it's going to be next year. And just because something was not hot next year doesn't mean it isn't going to be next year. And rather than trying to gamble with your money and trying to divine, we think it's going to be small cap growth in the next 12 months, so put all of your money in small cap growth. If we were right, we'd make more money than we would by having in a diversified portfolio. But if we were wrong, we could hurt you badly. That's why we diversify among the different markets and in turn within the different markets. That way, whichever one turns out to be the best performer in a given period of time, some of your money will be in it. Whichever one of it turns out to be the worst performer, only some, never all of your money will be in it. So the best investments to have long-term portfolio are stocks. Now, not everybody has the stomach, the psychological mindset to be able to endure the significant short-term price fluctuations that come along with owning stocks. I would say that's the price to pay for those higher returns, is you have to be willing to endure that. And that's where bonds can have a role in the long-term portfolio also. Bonds haven't given investors the rate of return that stocks have over the long haul, but at least they've historically outpaced taxes and inflation. You'll want to build yourself a very diversified portfolio using some combination of these different asset classes to give you the best balance between a high rate of return and the amount of fluctuation that you can live with. If you think you might benefit from a long-term relationship with a financial advisor, reach out to us to see if we might be a good fit. Let us know your thoughts and questions in the comments below. For more on investing and retirement planning, watch these videos next.